Hi, my name is Ilya Zlotnick, advisor and partner with Vivaldi Capital Management. And welcome to today's conversation with David Sternberg. David is the CEO and co-founder of Vivaldi Capital Management. David, it's great to have you here.
Thank you.
This truly is a very special episode. You and I have been working together for 10 years. So I started in 2014 at Vivaldi as an advisor. In 2012, you co-founded Vivaldi with Randy Golden. And it's been an amazing ride. You truly have been a mentor to me and a huge part of the success that I've had as an advisor, and obviously the huge success that Vivaldi's had. So we'll talk about Vivaldi and how you built it. But you've had multiple different career paths and entrepreneur wins throughout your career. So we'll talk about the hedge fund of funds that you built and navigated through very difficult market environments and that you sold. And then you initially started your career as a trader on the floor of the Chicago Board of Options Exchange, also navigated some extremely difficult market environments and had a very successful career. So let's start there. What initially led you down the path of starting a career as a trader on the CBOE?
Well, that wasn't really my career path out of college. I got my Illinois real estate license. That was the path that I was going. I was in a situation where I was at my sister's house and a friend of hers was over who was a trader. And he just happened to mention, why don't you come down and see the trading floors? I was just out of college and I never knew a trader in my life. And I just said, that's interesting. I'll go down there. And I went down to the trading floors with him and walked onto the floor, and kind of the energy and everything about the trading floors that exists was extremely appealing to me. And I kind of looked around and I knew this is where I'm supposed to be. And that's what happened. And I decided right then and there, this is where I'm going.
That's amazing. I mean, you were like 22, 23 at the time.
I was 22.
And like right off the bat, you find a place that felt right.
Yeah. The thing about the trading floors, the big thing there was you got to find a way to get there. And people get there as runners, clerks, in some way. And I got a job as a runner for about a month. From there, I met some people that I was friendly with, and they were traders, and they brought me on as a clerk. Did that for a month. These were all very fast ways to get to where I wanted to get to. And right from there, my father lent me $18,000 to buy what's called a special seat. If there were 2,000 stocks you could trade on the floor, the special seat enabled you to trade one of 20 stocks. It was kind of like a starter way to get on the trading floors.
Training wheels.
With training wheels. And I did that. And the one thing I found was for the 6 months that I did that, had no idea what I was doing, but I knew I was fast. I could calculate numbers. I could calculate fractions. And that was a huge leg up on the floor because it's a competition, basically. You're trying to beat the next person to a trade. That's how they happen. And that was my, getting onto the floor initially. And then from there, the guy that introduced me to the floor, he had a partner they were both sizable traders on the floor, and they decided to start a trading operation, and they brought me on as their first trader. So I went from trading in that starter pit to going on with them. And from there, I went into the Federal Express trading pit in 1982.
Yeah.
And the Federal Express pit was probably one of the most active trading pits on the floor. And it was a place that really enabled me to learn some real skills about how to trade. I developed my own style, my way of hedging, and something that was kind of unique compared to other people. But that was my...
How did you develop that style? Did you learn it from somebody else, or is it just something that came naturally?
So I'll tell you the story because it's kind of a strange story, but there was another guy, we'll call him Doug because that was his name. But I was in a pit. In the pit, there were probably 50 people.
By the way, what do they call you? What was your acronym?
My acronym was BST, which when you have an acronym, people
So it's Beast.
call you by a nickname. Well, it was supposed to be for Best.
Yeah.
Our family's company was called the Best Kosher Sausage Company.
Okay.
But right away, a certain trader named Irv Kessler, who's very well known and we invest with today in a significant way, Irv started calling me Beast. And that is how I got my nickname Beast on the trading floors.
It's just funny because I get clients from time to time who are former traders who knew you, and they're like, say hi to Beast.
Nobody knows your actual name. That's just kind of the way it is. But no, I was in the trading pit, and Federal Express was a very big tax rolling stock. So you could, using options, you could roll your gains to the next year and defer taxes and not pay taxes. And it was a huge thing around the floor.
Yeah.
And, you know, I kind of saw certain relationships with options. And this guy, Doug, who happened to play professional football, he weighed 300 pounds. He was actually very, very smart. And Doug and I are standing at the back of the pit. And
By the way, being big in the pit was probably an advantage, right?
being tall
was it
is
tall?
definitely an advantage. And he was wide and tall. So, yeah, that's an advantage.
Okay.
But no, Doug and I, we just started talking about certain relationships with options that we saw. And it was, for me, an aha moment. It enabled me to trade. It was a style of trading butterflies, which was a certain style of trading on the floor that was not really done by anybody, and created a certain way of trading them that was very effective. And that turned out to be kind of the backbone of my trading strategy on the floor. Every trade I was doing was completely hedged all the time, which was a big advantage. And it was really within a short period of time after that. It was probably a year and a half or a year after that. My contract I had with my backers originally, my contract with them was a 3-year contract. But if you make a certain amount of money prior to that, you're out of your contract. And I was out of my contract in like 2 years or a year and a half.
You're like a free agent.
So I did well. It was just a good place to be. And it was from there that I started bringing on traders. And that's where I had my best friends that were lawyers, doctors, MBAs. I mean, you name it. And I'm like, come down to the floor. I'll back you. I'll train you. I'll teach you. And that's what I did in the OEX pit. I brought a number of people down and did that over a period of many years.
Yeah, it's amazing. I mean, there's a few things. First of all, Scott Hergott was one of those that joined, and he's director of research of Vivaldi. You guys have been working together for
Scott
30 years?
started trading in 1987.
It's 40 years, effectively, almost.
What's that?
It's 40 years.
Yeah.
It's amazing.
But no, Scott and I developed a great friendship.
Yeah.
Scott was a great trader, and so he was one of the many that I brought on, and it just was a wonderful career down there.
What's amazing that you talk about is, well, first of all, you were on the floor for 15 years. You developed this style, and the level of discipline to stick with that style, because you probably were making money consistently, but there were people that were making more money than you in any given day because they were more aggressive. So let's talk a little bit about how over those 15 years, I think you said you had 5 losing days. And then also not to mention that in 1987, your experience, because 1987, for a lot of people that don't know or a lot of people that do know, was one of the worst market days in history. I think the market went down 25% in one single day. And you literally said people were being carted off the floor.
Yeah.
Yeah.
Yeah. 1987 was a kind of defining moment for traders in general, everywhere. It kind of put your discipline and kind of your risk management to the test in a way that a lot of them were just not ready for. So, you know, one thing I prided myself on was 1987, I had 20 traders on the floor. The crash hits. We made money on the crash.
What was it like that day? You come in, like nobody knew, it was a normal day.
Well, it was a normal day, but You know,
First, it was a normal day.
at first it was, but no. Then when things started to really
Was it just at the open and initially things started to unravel?
it was at the opening, everything was unraveling, and it was just mass craziness.
Yeah.
And one thing I always instilled in my traders, used to drive them a little crazy, but we would hedge buying certain options that people would just not buy to hedge because they're so far out of the money.
The chance of you losing money on them is like,
Right.
well,
Why am I buying this? This is throwing away money.
Yeah.
And my answer was because you never know. And
that's incredible foresight, by the way.
it's not necessarily incredible foresight. I mean, call it what you want to call it, but we do this to this day. We look at tail risk. We look at, not what can go right, but in an event that you have the 100-year flood.
Yeah.
And something goes wrong.
By the way, those floods happen more than one.
And now, now the flood happens often.
Yeah.
But at the time, there had never been any real event in our lifetime, certainly in my lifetime, that there was something like this that was so catastrophic to traders. And I witnessed people, losing $100 million in a day.
That's insane.
It wiped out 80% of the customer base of the Chicago Board of Options Exchange, because what happened is the clearing firms on the trading floors, they just never managed risk properly.
Yeah.
They would let their traders go in and carry positions that they didn't look at it. They didn't look at that tail risk and what if. And when it happened, it just destroyed a lot of people.
Yeah.
And it also exposed who were the ones that really understood what they were doing in trading and who were the ones that didn't.
Or just got lucky along the
Or
way.
just
rode the wave.
Well, all of a sudden, the getting lucky part, it got exposed. That those people, as I mentioned, were carted off the floor, literally on that day. And that's what happened.
That's amazing. I mean, you have to have really a lot of discipline. You have to be very contrarian to stick with those kind of methodology day in and day out for years and see other people make more money. What's interesting as a corollary to today is, we think about it, we're kind of like in this somewhat mania. Like the market just keeps going up. Everybody wants access to AI. AI is the future, but I think this is where as advisors, we have to kind of stay the course and be disciplined and be focused on diversification, because at any time, anything can turn around and turn around really quickly.
Well, the tendency for people is to forget very quickly what happened.
That's right.
So really bad events like 1987, initially people were terrified. But that goes away in a couple of years. Before you know it, people are doing the same old stupid stuff they did before.
Yeah.
And then you had 2000, 2001, 2002, when you had the tech crash. And there it is again. So many people just got killed riding this wave up, thinking it can never turn around and go the other way. And that's just being very short-sighted and very bad management.
Yeah. Well, we're back at it in terms of how people view the world. They think things can only go up. AI is only going to go up. Eventually, things will turn. People will remember, and then they'll forget again. One thing I want to talk about is, just to back up a little bit, early in your career when you first started, your dad backed you. You said he gave you, what, $18,000?
Yeah.
And talk a little bit about your dad. He was the CEO, the president of...
We had a family business, started in 1886.
Yeah.
In Cincinnati.
It's
the Best Kosher Sausage Company, and it was a national company that it was kind of funny because growing up, when my friends, it was kind of pretty unknown company, and people were thinking, oh my God, they must be flooded with money. It was not the case. And the reason that was not the case was we probably had 50 family members in the business, cousins, you name it. And one thing my father said early on was, you don't want to go into this business. There's just, it's as great as the business was. They never did all that well because there were just so many owners.
Yeah.
It just made it very difficult to achieve any real success. They sold the company in 1992 to Sara Lee, and that was the first time in my father's life he ever made any real money at all.
Yeah.
So a lot of people, it wasn't what it appeared to be.
Yeah.
Well,
was there any, like, growing up, you probably saw your dad go to work, you probably were involved. Were there any lessons that you learned in running a business from your father that you took with you?
I think first of all, my mother always worked as well. It was very rare at that time to have a mother and father that are both working. My parents always worked. I grew up in Wilmette. I had a great childhood as far as I knew. I mean, we had a great life, but it was tough for them. We didn't take family vacations. We didn't, my father was just very careful about never extending to a point that he just couldn't afford it.
Yeah.
And if there's a lesson I took from that, it's, kind of like even in trading, when I bought my first condo in 1986, I bought a condo. The price I bought it for, I probably could have bought it for 5 times what I paid, but I was always terrified. I don't know if tomorrow's going to be there in trading.
Yeah.
So I always just looked at it as, you better make it while it's there. It's kind of, being a trader is kind of like an athlete. You have a finite life. When you're done, you're done. Nobody cares about you, and you probably have no value. And that's the way I always looked at trading. Like if there's an end date or the music stops, I want to be in a position where I've put it away. I don't have to think about it for the rest of my life.
That's an interesting segue to the next thing that I want to talk about, because you were able to reinvent yourself. A lot of traders weren't. You hear stories about these traders that did extremely well on the floor, spent all their money, but when that world disappeared because of technology, now they're, Walmart greeters or whatever they are. So, at what point did you realize that this was not what you wanted to do? And then let's talk about kind of what you did after that.
Yeah, that was a moment that is very vivid in my mind. We'll call it an aha moment, but it was 1996. I'm in the trading pits. And the one thing I did, I truly, if I had 5 losing days in 15 years, that was probably an exaggeration. It's probably less than that. But it was only because I was nuts about hedging everything at all times. And I had a day in 1996 that I made a trade, turned around, lost money on it, not even anything meaningful, but it was the type of thing that I never would do. And, from a discipline standpoint. And I realized right then and there, look, I did very well on the trading floors, but when I started, it was like I just didn't care at that point in time. And I was getting burned out. It's very physical. If you were somebody that talked to me in 1996, I had no voice.
Yeah.
During the day, literally when the day's over, almost nothing would come out when I would talk. So, that was what would happen because you're yelling constantly. And so it was a combination of the physical impact. I did well and I was able to walk away, but it was also that the really big moment was when I realized I just didn't care about the discipline anymore.
Yeah.
And to me, that just didn't interest me in staying down there.
Yeah.
So that's where I decided.
I wasn't in the game anymore.
It was gone.
It's gone. So then you retired, right, for like 6 months. And you talk about how that was like the worst time.
Yeah, retired for 6 months, got an office with a friend of mine, and we were going to find a business to buy or something to do. Call it as another friend of mine. I was 37 years old. There was another loser friend of mine who also decided, he had sold his company and let's, find something to do. And I use the word loser. I don't mean that. You can't walk away at 37 years old. It's just very difficult to do mentally, for me anyway. So did that for about 6 months, and it just didn't interest me to be retired. I needed to be mentally challenged.
Yeah.
So
at that point, then you decided to manage your own money and your family's money, right?
Yeah, I started to manage our money, and
We'll talk a little bit about how you had all these relationships with great traders.
Yeah.
On the floor. They were at the same stage of their careers that you were. It sounds.
Yeah,
they were.
A lot of them were, and the trading floors were like it was a feeding ground for, I think, probably the greatest hedge fund managers. Call it private equity, private credit, whatever you want to call it. The thing about great traders, they understand managing risk. And they thought about risk the way I thought about risk. This was not about managing money in a way that I'm going to hit a home run or a grand slam. I don't need to hit a home run or a grand slam. If I can just get a solid return year in and year out and have it not correlate to the stock market, that was my dream. That was what I wanted. So I went from having my money managed at a well-known manager, Harris Associates, in Chicago. Great people. I had a great relationship with them. They managed me for about 10 years until I left the floor in 96. And, but, I was the guy that went to them at the age of 28, and I did very well at a very young age. And they looked at me and they were like, David, you're 28 years old, you've done great. You should be 75% stocks, 25% bonds. And I looked at them and I was like, I want to be 75% bonds, 25% stocks. I don't need the risk.
Yeah.
And, it's like, because it had that mentality in my mind, I can't repeat what I did on the trading floors. And I just don't want the stock market to dictate something in my life when I just don't need it. Needless to say, the 10 years that I was with them and when I left, I would have made a lot more money if I was in stocks. There's no doubt about
Yeah, but your
that.
approach is very pragmatic.
I didn't care. That's not what it was about. So when I left, when we broke up that relationship, I decided to start investigating these things called hedge funds, private equity funds, real estate funds, and they were completely new to me. But what was not new to me was kind of things that I looked for with risk. It was just like when I was trading. I just knew the things that mattered to me in terms of risk and how I looked at risk. And that's just kind of inside of me how I evaluated the funds I was looking at. So, that's what I did. I started going to a number of these guys, from Irv Kessler to Andy Redleaf. They all started famous.
Yeah, I mean, they're
funds,
huge names. We invest
and
with some of them now.
We invest with a lot of them, right? Some of them now, and there were people that I knew very well from the floors.
Yeah.
I was probably one of their initial investors, but that was kind of the infancy about investing in alternative investments. So I did that for about 4 years and built a portfolio of about 17 different investments, very diversified. One common theme: in theory, they should all be able to make money in up and down markets. Needless to say, 2000 hits, and just prior to 2000, I decided to start a fund of funds with one of my ex-traders and another firm that he was with. They were ex-traders also. They had a wealth management firm, small. But I said, again, I was in a situation where I had people from my country club, people that I've known forever, that they just liked the style of trading or of investing. And I had people asking me all during that 4 years, can I do that?
Yeah.
And the answer was no.
It was so different. Like nobody else.
It was very different, but I wasn't in the business of taking other people's money. It's just not, it didn't even interest me.
Yeah.
And, but now got to late 1999 and, it was just really, there was a lot of demand and interest. And I decided, you know what, let's make a business out of this because I love it. And I think it'll be fun.
Yeah.
Partnered with these guys, and that's where we launched our fund of funds in late 1999. And we were managing about $350 million, 100% by word of mouth. It was never, we weren't cold callers. To this day, we're not cold callers. We just built it by reputation.
But so 1999, you had that huge market bubble with tech.
Yes.
People are like, tech's going up forever. It's never coming down. It's reshaping the world. And here you are, you're probably making very consistent returns along the way. And then 2000, 2001, and 2002 hit, all negative years.
All negative years.
You made money every
year? We
year?
made money every year.
Amazing. Yeah.
And, that was definitely putting us to the test.
Yeah.
And quite frankly, at the time when that hit, I mean, look, we thought we had the right makeup of funds and that it would do well. It turned out it did do well. But that was, still kind of a testing phase because it was still new. It was still kind of putting our knowledge to the test on kind of what I thought we knew and what made sense to invest in. And it turned out to work out well.
Yeah. That's another remarkable story of managing risk. All right, so you did that for a few more years, and then I think 2007 comes along and you decided to sell it.
2007, we sold a majority interest in the firm, and when we
Why did you decide to sell it?
First of all, the one thing about the fund of funds business, and I just to this day I will say, I hated raising money for fund of funds for the simple reason it was a limit on. We were not great capital raisers. That's just not what we do, really. It was all word of mouth and stuff, whatever. But the reality is, fund of funds, you give somebody $1. Let's say we had 17 different investments. You get a piece of all 17. You can't parcel them out. You can't say, I only want this, I only want that. And in a perfect world, that is really the way that I envisioned managing money at some point.
Yeah.
So when we sold the majority interest in the fund of funds, right not long after that, 2008 hits.
By the way, you have impeccable timing.
Impeccable timing. Call it whatever you want. Call it whatever you want to call it. But when the people that bought us in 2007, what happened is in 2008 the market crashed completely. Yeah. We happened to have a portfolio that had significant liquidity.
Yeah.
Because I mean, just a lot of the things we invest in, hedge funds, they've got 90-day notice for quarterly liquidity.
Some of them were making money too.
And a lot of them were making money, but no, we lost money in 2008.
Yeah.
But, I mean, not relative to the market,
Yeah.
Nothing like that. But what happened is we had probably 25% of our investor base was reaching for liquidity, which we had it, okay? But the reality was, if we just gave them that liquidity, that would create a portfolio that is extremely unbalanced, and that made us very uncomfortable. The people that had bought us made a decision. We had said, look, let's just gate and treat everybody, equally. We'll figure out, how to give money back. They didn't want to do that. They probably didn't want to get sued, even though it was totally fine. And they decided, we're giving everybody their money back and we're closing the fund.
Oh, they wound it down.
They wound it down. And that's what we did. We wound it down, and, everybody got their money back. And when that happened is when I approached Randy Golden, who's the co-founder of the firm.
He was an early investor.
Randy was one of my initial investors. Somehow we got introduced, and Randy loved our non-correlating investments. He liked that as a proxy for stocks for his clients.
Yeah.
Randy had a wealth management firm on his own, and Randy and I always hit it off philosophically on how to manage money. And so when this all happened, I said to Randy, again, here I am faced with retirement again. I had no interest in that.
Yeah.
And we had demand all over the place from our clients.
That was what, 15? That was like 12. That was like 15 years ago.
It was 15 years ago.
Yeah.
We had just demand from our clients. We're like,
you were like, what, in your early 50s at that time? Okay.
Yes. What was I? My God. Yeah.
Okay.
I was 50.
Got it. Too early to retire. Okay.
Yeah, too early to retire. But, we were kind of faced again with a situation where I had family, friends, clients were like, we're closing down the fund of funds. They didn't want us to close the fund of funds at all. But turned out to probably be the best decision that ever happened. But they were like, can't you just manage our money?
Yeah.
Can't you do stocks, bonds, everything? Like, yeah, we've done that our entire lives. I mean, that's like easy for us.
Yeah.
But so I said to Randy, let's marry wealth management, traditional wealth management, with the alt world.
Yeah.
And the one thing I did was I was able to go to these managers, and that were all significant minimums. They were $1, $5, and $10 million minimums per investment. And I went to the managers and basically said to them, I'd like you to let us have a minimum of, call it $100,000 or $250,000 per investment. We'll be a free capital raiser for you. And, I'd like to be able to bring in clients one by one. Some will be bigger, some will be whatever, the minimums, but I got them to do it, and virtually all of them said yes to that. And that is really how we got into the business of marrying, alternative investments with traditional investing, by enabling people to go direct to these investments. we would do the sub docs for them, and
I remember those days.
You
When there
remember
was
those days.
Literally thousands of individual sub docs. It was a nightmare.
it was a royal pain. And we've since definitely automated dramatically how we
Things have become
do that,
much easier.
and now it's extremely efficient and simple. And
One thing I want to bring up that I thought was really interesting, the way you managed that business early on, is you brought in Mike Peck, who is, has been instrumental in what we've done, and then Chad Eisenberg. And very early on, you kind of gave them equity and brought them into the business and gave them a lot of power and room to maneuver to build a business. Kind of, what was your thinking about that? Because a lot of people in your kind of where you were in your early to mid 50s, you got guys in their 30s, might have not done what you did. But it made all the difference to where we're at now, I think.
I think it goes back to my trading days, only because my philosophy was, the one thing I could do when I could teach traders how to trade. I knew the style I wanted to trade, but back office, I had no interest in having anything to do with running the actual business. So even in trading, I had, a couple of partners, and in bringing on traders, and, they would run the back office stuff, all that stuff. And, that was just my comfort zone. So now getting into this business, now we're looking to really grow. And, Randy and I decided we need certain people in place to, really run the business and really scale this and build it in the right way. I'd never thought it would build like it is today.
Yeah.
Candidly, never. There's nothing about me that ever thought it would be.
We got effectively 10 billion across both business and management. You started with 100.
Started with a couple $100 million, Randy and I. But the initial, it's kind of funny, the initial meeting that I had with Chad Eisenberg and Mike, somehow Chad and I got introduced, and we were meeting for lunch. And Chad said, "Can I bring this friend of mine with me? He's looking to leave too." And Randy and I had no interest in anybody else. We knew what we wanted. We wanted Scott Hergott for research.
Yeah.
This was a known...
You took away from Citadel, effectively.
We took him away from Citadel. Scott, how could you want to stay at Citadel when you could go to us? We make no money, and, it's a wing and a prayer. But come on, we're going to build something. And Scott's like, I'm in. That's what happened. So Chad comes to lunch, and meeting with Chad, and Chad was perfect for what we were looking for to really build our back office, everything. Chad had an accounting background and was really kind of perfect. Then there's this guy, Mike Peck, and there was just something about Mike that it just got to a point where Mike's like, first of all, he's like, I'd love to come join you guys.
Yeah.
We had no position, no nothing.
Yeah.
But I remember turning to Randy and basically saying, look, I have no idea what this guy's going to do, but he's clearly got an incredibly creative mind.
Yeah.
And I think we really want him in the company. And I said to Mike, I think Mike was making, you'd have to ask Mike, but he was probably making $100,000 a year, $125,000 a year where he was at the time. And I said to Mike, look, come to work for us, except for one thing. I think we're going to pay you $50,000 or $75,000. And, if things work out the way we think they will, you'll have ownership. And, Mike just basically said, I'm in. Just completely on a handshake, just trusted that.
Yeah. And he had young kids at the time. He just had his first or second kid, I think.
I don't think he had his first kid yet.
Yeah.
He might have. Actually, no, he did.
Yeah.
He did. That was right when he was having his first child.
Yeah.
But, we basically shook on it. And honestly, the rest was history with Mike, because Mike has been incredibly instrumental in the business. So,
yeah, absolutely. He's been brilliant. I actually remember when I started, I got a call from Chad Eisenberg, because I was working with you guys at TD.
Yeah.
I actually remember in 2012, you came in because you get approved on the TD platform, and you, Randy, Mike, and Chad come into the office, and you start talking about alternatives. I knew nothing about alternatives at that time. Everything was stocks and bonds and planning. I was like, these guys are amazing. And I remember going back to my desk, super pumped up and inspired, started calling people. I'm like, you got to talk to these guys. And then I remember making a lot of intros. Ended up leaving TD, did a few things here and there. And then Chad calls me one day. He's like, we're starting this new business. It's an asset management business. Would you want to come over and be a wholesaler? And I remember coming in, talking to Randy, talking to all you guys, getting a job. And then the wholesaling business wasn't for me, but that took off completely in its own right. But then there was this whole opening in the on the TD side to focus on being an advisor and working with that. So that's been amazing. What else do you think, you did, or, that kind of created the opportunities for what Vivaldi is today?
I think a lot of that has to do with the people. I mean, it has to do with my partners. I mean, we're opportunistic. I don't think you can't put us in a certain box as an investment advisory firm. When we see opportunity, we are very interested in going for it. We all were like-minded like that, where, the big thing for us was risk. If we could get a handle on the risk, and we knew we're investing $1 in this business to launch this, and we felt if it doesn't go right, we're going to make money still. That was kind of the way we looked at it. And that's how we got into the mutual fund business. That came out of Mike more than anything. He had a vision, and we looked at it and just said, look, we kind of created a situation where we felt there was minimal risk at all. The risk is, okay, it doesn't work. But that's really how we did it. I think a lot of firms would probably look at that and say, there's no way I'm deviating from this or that, which might be the right move actually for a lot of firms, but we're just very entrepreneurial.
Yeah.
And especially as it relates to finding investments where we could bring our clients in, where they could partner with us and be a part of certain opportunities that we find. And that's what we've done, over a period of years.
That's one thing I appreciate, is the entrepreneurial nature. I don't think that edge has left as we've gotten bigger and bigger. So for you, how old are you?
65.
65.
I don't think you're allowed to ask that question.
Well, we could edit that portion.
I'm kidding. I'm joking. You could ask that question. I don't care.
So the reason I ask is, you still have that fire. Like every day you wake up, you're going home. I mean, you wake up at 3:00 in the morning, but that's not normal.
No, it's not normal. But that goes back to my training days, and I haven't been able to get rid of it.
Okay, so you wake up at 3:00 in the morning, you're texting, you're calling people, you got that fire.
Well, I'm not calling people at 3:00 in the morning anymore. But,
okay, fair enough. Maybe if you're in California, you're calling people in New York, but whatever. So, I mean, where's that fire come from? Like you still want to go. You don't want to retire anytime soon. Do you ever want to retire?
No.
Okay.
God willing.
So you're going to be carted off.
I'm going to be carted off. I mean, they'll probably want me. I'm sure at some point they'll want me out, but I'm not going anywhere. I love the business, and I feel a real responsibility in this business to, whether it's friends, family, people that came and they trusted me or trusted our firm to manage their money. I just don't feel walking away is in the cards. It's not for me, but so I plan on being here quite some time.
That's awesome. Well, that's one of the nice things about wealth management. You could do it for almost ever.
And you could do it remotely.
Yeah, exactly.
We're extremely technologically advanced.
Yeah.
So doing things remotely is not.
You've kept up nicely.
What's that?
You've kept up nicely.
Yep.
Maybe you'll wake up, you'll golf, you play some pickle.
Yep.
Get a suntan. And
kind of have your cake and eat it too by doing.
There you go.
Doing both.
Absolutely. Well, thanks again for joining, and thanks again. I mean, it's been an amazing run for honestly getting me and all the other employees and partners an opportunity to build something nice.
My pleasure.
All right.